Hello everybody, welcome back. Welcome back to the chat room. My name is Ed Ponzi. It's great to be here with you. It's a Monday in the late summer and it's the best summer ever. I hope you're having the best summer ever. Okay, you do what you can to make it a great summer. And if it's indeed summer where you are, perhaps it is winter. I do not know, because I don't know where you are. But let's talk about all this great stuff. The first thing we got to talk about is the euro, and this has just been magnificent. This trade continues to go our way, and now we're under 132, and we are only about 70 pips away from our third and final target, which was 350 pips away from the entry point, and that's astounding, because in a market that, everyone's crying about lack of volatility, if we can get this down another 70 pips or so, we get a 350 pip winner. That's outrageous. And so I'm very happy if you played along. And if not, listen, that's your choice. I'm not here to tell you what to do. I'm only telling you what I do, how I see things. And, these are not recommendations per se. I'm just giving you a chance to look over my shoulder and, see what I'm doing and listen to the nonsense that's rattling around in my head. Okay? Well, I'm in a great mood, because who wouldn't be? I mean, we're short from here, this green line. That's our entry point. You can see that's the big breakdown of 135. And once that broke, we got short. There's target 1. The reason why target 1 is a different color now, that's because the stop has been moved to target 1. That's where our stop is now located. So our stop is now 134.15. If our stop is hit, we get stopped out at a profit. Of course, it's a long way to our stop, because we really began to plunge last week after in anticipation of Jackson Hole. I would say that's really when the weakness began. And I wanted to show something to you, because I hadn't pulled that up earlier, but I was talking to various people about support levels. And somebody was very convinced that this level right here was, obviously we gapped through it, so hindsight is 20/20, but somebody was very convinced that this level was going to hold. And the reason why is they said, Ed, it's 2 Fibonacci retracement levels. And this person was right. If you draw from the low point way back here in summer of 2012, and that's the point where the euro turned. That's where Draghi said, we'll do whatever it takes to turn this thing around. If you draw from that low point all the way up to the recent high, which is just a few ticks under 140, then you're going to see that the 38.2 is right here, 132.46. That's the 38.2 retracement. It's right there. And we gapped past that overnight. And you could also draw from this level right here. This is the summer 2013 low. You draw from that low point to the same high point, and you're going to get the 61.8 within 15 pips or so of the 38.2 of that previous Fibonacci that we just mentioned. So you've got 2 Fibonacci areas there, 38.2 and a 61.8, and we've just gapped right past the both of them, and away we go. Will the price rally to fill that gap, I guess, is the question on most people's mind. Well, I'll tell you what, if it does, then that creates a shorting opportunity. Let's go to the shorter term chart. I'll take you to the 1 hour. And you can see what happened is we gapped down on Sunday night. The market reopens on Sunday night, and we immediately gapped down. And there's really been no bounce. We flirted with 132 back and forth since then, but there's really been no attempt to fill this gap. And that gap is right up to around 132.35 approximately, that area. If the price does rally to that 132.35 area, and assuming that you're not already short, that would be an interesting place to short the euro. Almost certainly there will be a rally, a counter-trend rally at some point. I mean, nothing moves in a straight line. And when you see those counter-trend rallies, that's very often those are creating, those are signaling to you, hey, opportunity is knocking. Okay, so listen up, opportunity is knocking. You don't want to miss it. You don't want to miss out on that opportunity. Okay? All right, so anyway, what can I say? We're very happy, we're very profitable, and, you know, we haven't had a lot of trades. I mean, and honestly, you know, that I think is probably, you know, frustrating, I think, for some people. But I'd be willing to bet that if we placed a lot more trades, our level of success would be lower. It may be frustrating for you to say, wow, Ed doesn't really trade very much. That's right. It seems like the less I trade, the more I make. Think about the money I'm making on this euro trade. Now, suppose I'd done like 5, 6 other trades in the meantime just to keep myself occupied. I probably would have lost a lot of those trades. And it's when you force them, that's when you lose. When they just occur very naturally and organically, that seems to me like when you win. So I don't push it. I don't push it. I would rather place one good trade than 20 mediocre trades, because I sincerely believe that one good trade will make more money than 20 mediocre trades. And this is something that I learned the hard way. You know, usually when you start winning, that's when you get excited. When you get excited is when you start pushing buttons. When you start pushing buttons is when you start to lose. When you start just willy-nilly hit buy, sell, buy, sell. I'm not thinking, I like trading, because trading, I make money trading and I like it. And then when you get carried away, it's no longer becomes an intellectual pursuit. Now it's become, you know, now you're just a trained monkey hitting buttons. You know, that's not going to work. And I've been that guy, I know. Okay, so if this makes you uncomfortable or impatient, I think what you're seeing is reality. And certainly there have been other opportunities that have been good. I mean, dollar-yen looks like it's breaking out, and that's, you know, finally, after all this time. But honestly, I don't worry if I miss a good trade or if I miss a good move. I get a feeling I'm missing a lot of bad stuff too. Does that make sense? Okay, let's get to some questions. And first of all, coming up about the euro specifically. Hi, Ed. Looks like there's continuing weakness in the Eurozone. If they start the quantitative easing program this year, would you look to entering another short around the 131 area, go past 130 and possibly 120? Well, here's the thing. And to call for 120, I mean, 120 is way down. That's down here, right, where we drew that first Fibonacci from. Well, consider this for just a moment, folks. If quantitative easing, this is the question I ask myself about pretty much anything. If quantitative easing occurs right now, would that really come as a big surprise? Would that shock people? Oh my gosh, quantitative easing, holy cow. Would that really come as that big of a surprise? I don't think it would. I don't think it would come as a big surprise. And therefore, I've got to believe that it's already being priced in. You know, you think about what happened. We went from above, close to 134 down below 132 in about 6 different sessions. So in about a week, this thing just lost hundreds of pips. And it only moves about 50 pips a day on average. So I'm thinking, man, something is being priced in here. Something is really being priced in here. So I got to believe that an announcement of quantitative easing doesn't necessarily drive it a lot further down, because I think it's expected at this point, at least to a degree. Great question, though, because that's the question. That's a fantastic question. The man is asking, would you short it again if they do QE? If it comes up a little bit, would you smack it down and maybe try to ride it down to this 120? I think it's being priced in to an extent already, so I don't want to be too greedy. But it's an interesting question. So let's see what happens. I mean, if we make it, first of all, if I make it to that target, I will reassess. My first instinct is to say no because it's probably priced in. But really, it depends on the scenario once we get there. I mean, let's say that we make it to our third target and then the price comes flying up to an area that I think looks like a good place to short. So if you can give me like a good technical setup that coincides with what your fundamental concept, then I think it's very possible that it could. So really just it depends where we are if and when that happens. And at this point, if it doesn't happen, I think the euro turns around and roars higher because there are a lot of people who are already short in anticipation of quantitative easing, and if they don't get it, they're going to cover their shorts. Great question, though. Thank you for that. And we do appreciate all of your questions. Do please continue to keep them coming in, and Rick and I really enjoy them. Send them to info@edponzi.com, and we will get to your questions. We have another one here. This one is a series of questions, actually. The first one says, what do you think of the labor market conditions index that was recently introduced by Ms. Yellen? Now, Ms. Yellen, Janet Yellen, the head of the Fed chairperson, recently introduced something called the Labor Market Conditions Index. It's got 19 different components, and the Fed says, okay, this is now what we're going to look at for the labor market. Now, here's the thing. Every central bank is constantly either fooling around with the existing statistics or, in this case, creating brand new ones. The statistics are not created to shine a light on the problem or provide greater information. The statistics are created to reinforce and stand behind whatever it is the Fed already wants to do. So I have no doubt. I think Yellen's a dove. She's always been dovish. I have no doubt that Ms. Yellen is a dove. I think that this index is designed to make the labor market look stronger than it is, stronger than it really is. And I mean, this happens everywhere in the world. I mean, China does the same thing. China did an amazing thing with their CPI number about 2 years ago. About 2 years ago, housing prices had been going up, 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 up in China, and then they began to plateau, and everybody was saying housing bubble, and everyone was saying the housing prices would come down. Meanwhile, the price of food kept going up, 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 and people started getting upset because the CPI in China kept saying, hey, food prices are going higher and higher. So what do you think China did? They took that number apart and they said, okay, let's make food a smaller part of the end number, and we'll make housing a bigger part of it because housing's about to collapse. So therefore, rising food prices will have less of an effect on CPI, and falling housing prices will have a greater effect on CPI. In fact, a greater effect than they did on the way up, because now that the prices are up, now they're making it a bigger part of it. So what are they really doing? It's just a little bit of sleight of hand, isn't it? They're trying to make the numbers say what they want them to say. And so if you can do that, if you can create numbers that say what you want them to say, then all you say, see, we have proof. The funny thing about the Fed is the Fed will tell you that quantitative easing worked. And they've been saying it for years, even though the economy still stinks. They've been saying for years, we have proof that quantitative easing worked. Now, what sort of proof do you think the Fed has that quantitative easing worked? Well, there was a scholarly paper written essentially that proves that the Fed was right all along about quantitative easing. But who do you think wrote that paper? The Fed. So the Fed writes the paper and then uses the paper to say, you see, we have proof. We have a scientific study that says we're right. And therefore, we're going to keep doing whatever we think is right. And you know what? This is more of the same. So don't get too excited about this index. we might have to start paying attention to it a little more down the road. But I just want you to see it for what it is. With the introduction of the new index, is it possible for us to see the interest rate being raised early next year, or is it just to slow things down? I would say it's just to slow things down. Yellen probably is in no hurry to raise rates. You'd probably love to have an excuse to not raise rates. Therefore, we're going to create a new number that gives us an excuse not to raise rates, and that is the way the Fed rolls. Draghi mentioned something on austerity. Can you please explain it in simple English? Draghi said, hey, listen, we don't have to do so much austerity now, but that's kind of a funny statement. There's really not a lot of austerity actually going on in Europe right now. And so like it's like calling for an end to something that isn't even really happening. But yeah, he felt a need, I guess, to say that, maybe countries can be more aggressive. This is from the Telegraph. ECB's Draghi opening to the easing of austerity. He wants countries to spend more money. He wants governments to spend more money because he believes that government spending will create jobs. And that he thinks it'll reduce unemployment and it'll stimulate growth. I don't know, it seems to me that the best jobs are always created by the private sector, and the private sector has just gone missing, like, for so long now. I think it has to do with a lot of rules and regulations that have been forced onto the private sector, is that they can't function the way they used to. That's just my opinion. I could be wrong. But yeah, he's saying, yeah, listen, we don't have to be so austere, but they're really not that austere. Countries that are austere tend to be the ones that have the best economies, like Germany. Germany's faltering now. And sometimes I wonder that it could be the sign of something wider that's happening, because, the U.S. had a negative GDP in the first quarter. Japan had a negative GDP in the second quarter. Many of the European economies are flat to negative in the second quarter. It's kind of scary when you add it all up. So I wouldn't put too much stock into this. It's not as if they're being tremendously austere already. How do bonds work in developed country compared to a less developed country? It's a good question. By the way, did anyone see the yield on a 10-year German bond today? It's 0.95%. 0.95 is a 10-year yield. But people consider German bonds safe. If you go to a developing country, you're going to see much higher yields because, let's just say, I bet everybody here is glad they didn't buy Argentina bonds, right? Because they're worthless, because you're never going to get paid. So obviously, that's the kind of stuff that scares people. So in order for developing countries to make their bonds more attractive, they offer higher yields, higher interest rates. So the safest bets are the ones with the lowest interest rates. The less developed countries have the higher interest rates to make them more attractive and to attract buyers. Okay, and that's really how it works in developed countries versus less developed countries. If the oil price keeps falling, will it affect the Canadian dollar? Yeah, almost certainly. If we take a look at CL, there's oil. It really hasn't moved much over the past few days. It's just kind of marking time, but it's pretty clear that we're in a downtrend here. Now, the interesting thing about Canadian dollar, a lot of talk about that right now is because, and here you see you're right up against resistance. I've laid out a trade here, and it's pretty much at a point where I'm thinking about pulling the trigger on this. I'll let you know if I do. But I'm looking at shorting dollar versus Canada. If it breaks up, if it breaks above here, that's an inverted head and shoulders, and I just close the trade. But if it comes up above here, you see, I'm not short yet. What I'm hoping for is a false breakout. If we get a false breakout on dollar Canada, and then it pulls back, then I've got them where I want them, because the breakout traders will be frustrated, right? If this breaks up and goes, let's say it goes above 110, that's going to set off a lot of buy orders. A lot of breakout traders are up there waiting for this to move higher. But if it breaks up above and it just turns into a wick and it fails, I think I'm going to short it around this S. That S stands for sell short. and the C stands for cover, like cover the short. I haven't set this into motion yet. I have my targets laid out roughly, and this might be the next trade for us. So again, I really would like to see the price come up to at least above 110 first. If it keeps going, I don't care. If it turns and comes back, boom, I've got them where I want them. Okay, and I cover if it. This is just rough numbers here because I've just been sketching this out. The entry is around 109.70. The cover is around 110.20. So it's about a 50 pip risk. The first target is about a 50 pip target. All right, so that first target is around 109.25. Again, I'm just throwing rough numbers out there. The second target's way down here at 108.25. The third target, 106.55 is what I came up with. Glad we had this come up right now, so I wanted to talk about it. I want the false breakout. I am not entering the trade unless I get a false breakout. How do you know the breakout is false or true? Well, I don't. If it breaks out, if the price shoots up to 110 and above, I have no idea if it's false breakout or not. But if the price shoots above 110, I activate a sell order at 109.75 with my stop and my targets. And if it keeps going up, my sell order will never execute, so I don't really care if it keeps going up. If it does turn and fall, though, now I've got them where I want them. Now, why do I like that false breakout so much? Why am I so keen on getting that? I mean, anytime you see a chart that looks like this, over and over again, the price just failing every time to get to 110. It comes within 20 pips or so, and then it just fails and fails and fails. So there's got to be somebody selling up here. I see the wicks. Somebody's selling and pushing it back down. I want to see these buyers get what they want. I want to see them get 110. There might be, 110 is a huge round number, so there's a very good chance that there is some sort of option barrier up near 110. If 110, in other words, somebody's probably trying to push this to 110 and hit that barrier. If it gets hit, then there's no reason to keep pushing, and it probably floats back down. So I want to see it at least get up to 110. If it gets up to 110, then I'll put in an order to sell short. Could that fail? Sure. It's possible that the price comes all the way up here, comes down, I get short, and then it goes up. And if it does, I cover, and I lose 50, 60 pips on the trade. No big deal. Okay, so S stands for short, C stands for cover that short, and 1, 2, 3 are the targets. And this is for U.S. dollar, Canadian dollar. As far as the price of oil, it has fallen quite a bit, but honestly, I mean, the trend is down. But the thing about oil is it'll never go to zero. I mean, if the price keeps falling, they'll just pump less of it, and you know, so they won't just flood the market with oil until the price hits 50 bucks. It's just not going to happen. So I'm not that worried about the price of oil driving Canadian dollar down. In fact, this move on this chart is more of a strong dollar move. If you think about it, the U.S. dollar is crushing the euro, crushing the British pound. It's not doing that much against Canadian dollar. So Canadian dollar is hanging in there. It's holding its own. And I like that. Okay, so yeah, I do have a setup in waiting for Canadian dollar. And I can take this trade too because I'm short the euro already and long the dollar. If I take this trade, I'll be short the dollar. It's a hedge. And I'll be long Canada. I will have a synthetic Euro-Canada trade, short Euro, long Canada trade if this occurs, because the two U.S. dollar positions are going to cancel each other out. Great questions. Thank you very much for that. I appreciate it. Now, we need to talk about the stocks too. Some of our stocks have done very well, some not. You know, first and foremost, gold has been a disappointment. Man, we're dumping this. We can't hold this any longer. We have to sell this. So we're going to put in the sell ASAP for gold. Thought it was going to work, didn't work. Our reason for getting in is gone. We got to get out. Let's talk about some of our long positions. Apple, AAPL. It's just the rock star. And that's another new all-time high for Apple. As I speak to you, this market's about to close on Monday. This is about to set another new all-time high for Apple. JCPenney's having a big day. Look at the big gap and go on JCPenney. What do you think? I think, you know what I think? I think they're starting to figure it out. I think we've been talking about it forever. And we've been long this since $8.60. Now it's at $10.68. So I don't know. I guess we're up like 20 to 25% on Apple, 20 to 25% on JCPenney. Gap and go, I wish it would have more volume behind it. I wish it would have more volume behind it. But I love the gap and go. I love the gap and go. And there you are, folks. That is going to be the all-time. That's going to be not the all-time closing high, but that's going to be, you're going to get an all-time high close on Apple today. You're going to get a one-year closing high on Penny, I believe, not quite 1 year. Maybe like 11, like 9-month closing high on JCPenney. All-time closing high on Apple. Dean Foods has been a bit of a disappointment. We're not exactly getting killed here, though. Lulu has been great for us on the short side. That's creeping up a little bit. TJ Maxx hurt us a little bit on the short side. Man, that hurt. I might have to cover that because we kissed 2,000 on the INX today, and then we pulled back a little bit. So it's like, I don't know, maybe we're going to get shy. We were above it intraday, but we did not manage to close above it. So you've got the Lulu is good. And the TJ Maxx did not do us any favors. Kimberly-Clark is not hurting us here. It's just up a little bit. Still hovering around its 200-day moving average. I love the fact that this thing is hanging on its 200-day moving average while the stock market hits all-time highs. That means I've probably shorted the right stock, and if this thing turns, it'll turn ugly on Kimberly-Clark, which is just way overvalued. Okay, all right. That pretty much is a wrap, ladies and gentlemen. I just want to say thank you so much for listening and keep sending in your questions and comments. I appreciate it. Hope everyone's having a wonderful time out there. I'll be back to speak with you again in just a few days. Until then, my name is Ed Ponzi. Thank you for listening, and I'll speak to you again very, very soon. Take care.